Most Canadians believe the ultimate wealth formula is simple. Buy your primary home, save up, and then buy a second property to rent out. You become a landlord, the tenant pays down your mortgage, and you coast into a secure retirement. But in 2026, that formula no longer works as easily as it once did. The combination of elevated interest rates, soaring maintenance premiums, and an aggressive tax framework means that what looks like an asset on paper can easily become a cash flow trap in reality. Today, we are putting the true cost of expanding your real estate portfolio under the microscope. We are covering both sides of the coin, the silent profit killers when you buy, and the heavy tax traps when you sell. This is a live lab check on the math behind a second property. Let's start with the buy side. Most buyers calculate cash flow by simply subtracting their mortgage payment from the monthly rent. That is a dangerous mistake. When you buy a secondary property in Ontario, you face a double-dip land transfer tax with absolutely no first-time buyer exemptions. Then come the operational friction points. Property insurance on non-owner-occupied homes has surged, and general maintenance costs across the GTA have risen sharply in recent years. If you aren't modelling a hard buffer for ongoing repairs and vacancies, your projected positive cash flow may disappear entirely. Let's pull up the spreadsheet and run a live case study to see how this plays out in the real world. For this benchmark model, we'll look at a typical Greater Toronto Area asset, an entry-level townhouse or two-bedroom condo purchased for $700,000, renting at a market rate $3,200 a month. These figures are illustrative and designed to show how carrying costs can erode top-line revenue. You put down 20%, which is $140,000 cash, leaving you with a mortgage balance of $560,000. For this benchmark model, we'll assume a standard 25-year amortization and a 4.5% fixed mortgage rate. That brings your principal and interest payment to $3,113 a month. On paper, the property generates $3,200 a month in rent. A casual investor looks at that and thinks they are breaking even or building equity on the tenant's dime. But watch how fast the math shifts when we layer in reality. Property taxes average around $300 a month. Dedicated landlord insurance adds another $120. Setting aside a conservative 10% of the gross rent for future maintenance takes away $320. And a 5% vacancy reserve cuts another $160. When you add those operational costs up, your true monthly expenses aren't $3,113. They are $4,113. Your projected break-even is actually a net negative cash flow of $913 every single month before tax. Worse yet, the tax landscape adds another layer of friction. Any net rental income, meaning your rent minus deductible expenses like mortgage interest and property taxes, is generally added to your taxable income and taxed at your marginal tax bracket based on total annual income. Depending on your tax bracket, a significant portion of your net rental profit may go toward income tax, drastically cutting into any actual gains you hope to use to cover that monthly cash flow deficit. But the real shock occurs when you decide to exit and sell. Unlike your primary residence, which enjoys a total capital gains exemption, a secondary property is fully exposed to the tax man. When you sell, you trigger a massive capital gain. Your capital gain is calculated by taking your final sale price, subtracting your selling costs like real estate commissions and legal fees, and comparing it to your adjusted cost base, which is your original purchase price plus any documented capital renovations you made over the years. Under current Canadian tax rules, a major portion of that net capital gain is considered taxable income, added to your return and taxed at your marginal rate. If your investment property has appreciated significantly over the years, that sudden spike can easily push you into a higher tax bracket, resulting in massive tax leakage that erodes decades of compounding appreciation. So, how do you protect yourself? If you're determined to hold a second property, your numbers must be entirely stress tested against the current macroeconomic environment. Your ROI cannot rely on the hope of infinite price appreciation or ultra-low interest rates. You must keep an immaculate paper trail of every single renovation to raise your adjusted cost base legally. And you must ensure the net rental yield is strong enough to survive the annual marginal tax hit. Before you expand your portfolio, ensure the numbers survive stress testing. If your spreadsheet can't survive today's rates, it won't survive tomorrow's market. Subscribe to stay ahead of the curve. Assumptions change, opinions change, the math doesn't. See you next time.